Liz Truss famously did not outlast the head of lettuce. And we're going to discuss why and how it's applicable to what's going on with us in here in the United States. So they were basically doing what we'll call a gilt basis trade. They buy the gilts and they would then go write the futures against the gilts, kind of like a covered call. And what happened was is um, Truss put out a budget where she was giving a tax cut of like $65 billion to the oligarchs and said that she's coming up with another 40 billion in spend for the poor people. Okay. With about $100 billion. So what happened was is no one was expecting this. No one thought it was a good idea. So the gilt went down in price. Okay. And so they lost on buying the gilt as a trade. Now on the other side, you sold, basically shorted the interest on the gilt by selling against it. You took in that money. But now the interest rates are higher and now you're losing on the trade. So you lost on both sides of the trade. And basically the word was is even though they didn't actually enforce it, that the entire pension fund industry was bankrupt. And you say, well, what's the big deal? You're on a covered call. Well, here's the deal. They would do the trade, buy the gilt, sell the futures. Then they got the gilt. They would then repo them overnight, get the money, and what would they do? They buy the gilts and sell the futures. Then they take those gilts and they would repo them, get the cash, buy the gilts, and so forth. So if they're typical, let's say you're just a pension fund, you may do that 5, 6, 7, 8 times. If you're a hedge fund, anywhere between 20, 30, 40, or 50 times. And so when they go down in price, it really hurts. So if they had enforced the margin before Liz resigned, a lot of companies would have gone belly up. And so thereby, Liz Truss resigned, the budget went away, never happened, and so forth. Now, in America, we have hedge funds, and they do the basis trade. Now, listen, I realize when we talk hedge funds and like private equity, I saw the other day there's 19,000 private equity funds, and there's 14,000 McDonald's. So we have lots and lots of hedge funds. I get it. We're not talking about that. We're talking about 10 or 11 hedge funds, basically in the Cayman Islands, that do the basis trade. Okay. And as you can see here, in the Cayman Islands, there's about 1.8 something and a half trillion of U.S. Treasuries, and then a non-Cayman, whether in America, or Europe, or whatever, there's about another 400 billion. So let's say about $2.3 trillion. You say, okay, what's the big deal? Well, look at what just happened. They say here in late 24, 25 to early 25, hedge funds hold an estimated 6 to 7% of the total U.S. Treasury markets. Okay, though official data likely understate the true figure due to offshore structures used by large funds. And so, according to the October 25 Federal Reserve note, the Treasury basis trade Cayman domiciled hedge funds alone held roughly 1.85 trillion in treasuries, up $1 trillion since 2022. And when adjusting for undercutting Treasury International Capital, TIC data, they estimate it's nearly $2 trillion, okay? Given total marketable U.S. Treasury debt outstanding of 30 trillion, that's roughly 6 to 7% of the market. But it's only been recently, like in the last 2 weeks, that we discovered that these hedge funds have $1.85 trillion. We were under the impression that it was $450 billion. And so there's two ways that they got information from the hedge funds, two totally different systems. And you can see them down here, the TIC system and the Form PF data. And the difference when we looked at that was basically $1.4 trillion. So the Treasury and the Federal Reserve had no clue that these hedge funds We're at almost $2 trillion, not $450 billion for the basis trade. Now, this organization, late last year, December 24, halfway through, wrote this article, and it was about that there's a whatever you want to call it, a committee of experts that advise the Fed. They look for issues that could happen, and then they say, look, here's something you should watch. Okay, and so basically they focused in on the basis trade. So, like the gilt trade, the basis trade exploits arbitrage between the treasury futures and the cash treasuries. You buy the treasury, you rate the futures that are deliverable into those future contracts. A hedge fund goes long the treasury bond and short on the corresponding futures contract that is trading relatively richly, i.e., more than the cash, with asset managers on the other side of the futures. So, in other words, you're selling the other side to asset managers. And that collects the basis or the spread between the two. And conservatively estimated, the basis captures 45 basis points annualized, which hedge funds lever up at least 20 times to repurchase agreements for about a 9% annualized yield. Okay. And they say that this is anecdotally a good approximation of the basis trade leverage, around 20 times. But this organization here literally went out and spoke to all the hedge funds, and they reported that the hedge funds were averaging 56 times leverage on treasury repo borrowing. 56 times. So what did we say before? You buy the bonds, you write the futures, you repo it, then you get the cash because you repoed it, and then you buy the bonds, write the futures, repo it, buy the bonds, repo it 56 times. By the way, that's on average. So that means people are higher for sure, okay? And you can see how the offset are here. Asset managers are buying the long, people are shorting, and they offset each other because this is the basis trade. You buy the bonds, you short the futures, okay? So what's the problem? Well, here's the problem, all right? Well, we know the great financial crisis was really a mortgage market at its core. The government bond markets at its center and asset managers of various stripes are the new key intermediaries in the market. In other words, before the great financial crisis, basically the largest holders of our bonds were foreign banks, okay? When I say foreign banks, central banks. Now, they're not the largest holders. The largest holders are private holders, private banks, hedge funds, and individuals, okay? As a result, the key risk today is liquidity stresses in the government bond markets. Hedge funds, in particular, have become key providers of liquidity, often employing highly leveraged relative value trading strategies, basis trade, by using government securities as collateral in the repo market to borrow. These boost returns, but are also vulnerable to adverse shocks in funding, cash, or derivative markets. 3 ways this trade can fail: funding, issuance, cash, or derivatives market, or all 3. This vulnerability has increased as the financing terms become increasingly lax. Haircuts have gone to zero, even negative, for the repo market. What does this mean? In other words, you give them $100 billion, they'll give you $100 billion back. No haircut. Now, it's interesting what they say could be the issue is if there is an event in the market, let's say in private credit, and then people are moving all their money around, they have to get new stuff, and then the banks start feeling, I don't know about these guys here, we're not going to give them 100%, we're now going to give them 98%. Well, when you're leveraged 56 times, 2 times 56, that's more money than you have, okay? So this could break the markets. Now that OMFIF article was for one thing, to convince the Fed to have a liquidity facility to buy all the bonds from the 10 to 11 basis trade hedge funds so that they don't blow up the entire U.S. Treasury market. That's what that article is for. Should we do that? And How can we not? Can we just found out that they have 1.4 trillion more